Hello, welcome to the Credit Compass, your guide to navigating the complexities of European credit markets. Each week we step back from the noise to unpack the developments shaping credit, explore the macro forces behind them, and discuss what they mean for investors and issuers across Europe and the UK. Before we dive in, a final quick reminder about our microsite on KBRA.com. You can find all my podcasts, newsletters, and quarterly reviews alongside my colleague Van Hesser, all in one hub designed to help you stay ahead of the macro and credit trends shaping the markets. Visit kbra.com/macrocredit to explore. All right. UK softness, unemployment up, but is AI to blame? Are we facing a jobless resurgence in growth, or is the labor market finally breaking under the weight of low growth and elevated debt? And speaking of debt, corporate borrowing linked to AI investments is accelerating as companies chase opportunity. Yet, Europe remains a bright spot for capital deployment, at least according to several of the major private credit and private equity players whose recent results suggest sustained confidence in the region. Let's start with the employment picture. Unemployment in the UK has ticked up to 5%, slightly higher than markets expected, and a noticeable shift from the sub-5% levels we've become accustomed to. That creates a tricky backdrop for Rachel Reeves's first budget, set for release in just 2 weeks. There's been no shortage of speculation about what she might do, ranging from fiscal tightening to targeted investment stimulus. But whatever emerges, the macro environment is already steering the near-term rate outlook. In the Bank of England's most recent Monetary Policy Committee meeting, the vote was split, ultimately settled by the governor. The hawks continue to point to wage inflation as the key sticking point. And they're not wrong to be cautious, but the data is starting to shift. Weekly earnings growth has eased from 5% to 4.8%. It's a small move, but it matters. Momentum is turning. And the combination of softer pay growth and rising unemployment suggests that labor market cooling is underway. Across the channel, the euro area looks steadier. Aggregate unemployment has held around 6.3% for several months, while wage inflation sits at 3.7%, considerably lower than the UK. But within the bloc, there is growing divergence. Germany's unemployment rate has risen 0.5 percentage points year over year to 3.9%, while France has edged up more slowly to 7.6% from 7.3% in late 2024. In other words, the euro area may be stable in aggregate, but the undercurrents tell a more uneven story, not unlike what we're seeing in the UK. Now, let's address the question that's stirring so much debate. Is artificial intelligence behind some of this softness in unemployment? A recent CIPD labor market outlook survey covering over 2,000 UK employers provides an early signal. Hiring expectations remain at near record lows outside the pandemic period, and notably 17% of employers expect AI to reduce their headcount over the next 12 months. Of those, about a quarter foresee cuts greater than 10%, primarily across clerical, administrative, junior management, and professional roles. The areas most affected are not necessarily industrial jobs, but white-collar, office-based functions, exactly the kind of roles automation can replicate efficiently. The other angle here is sentiment. Even employers who aren't cutting yet are pausing hiring to see how AI plays out. That wait-and-see stance can have the same dampening effect as actual layoffs when it comes to demand and wage pressure. On the positive side, at least from an inflation and rates perspective, the same survey shows pay expectations are easing, a trend that will be welcome news at the Bank of England. Last year, 45% of firms planned pay rises above 4%. This year, that's down to 34%, and those expecting raises above 5% have dropped from 34% to 21%. That's meaningful moderation. One of the few signs suggesting that wage price loop may finally be breaking. Taken together, the data paints a picture of a cooling but not collapsing labor market. one where technological adoption may be amplifying cyclical weakness rather than replacing it altogether. Now, turning to the private markets, recent results from leading managers show a constructive tone and even optimism. Despite macro uncertainty, firms see Europe as rich with opportunity. Apollo, already deeply entrenched in the region, is continuing to build out its European platform. They cite two tailwinds: a deep pool of private companies seeking non-bank funding and continued bank retrenchment from non-standard lending. Blackstone emphasized the same trend, highlighting their expansion in direct lending and infrastructure investment, especially in energy transition and digital assets. KKR, for its part, remains focused on AI-related investments, underscoring Europe's attractive relative value compared with the US. A recent commentary from the firm framed Europe as offering better pricing and stronger lender protections. Ares is scaling its direct lending platform further, while Amundi, from the public market side, recently spotlighted the resilience of European credit inflows, especially in investment-grade and short-duration strategies. The through line across all of these players is clear. Europe may be slower growing, but it's increasingly seen as a credit opportunity zone, where yields and spreads still compensate for risk and private capital can fill the gaps left by banks. Nothing new here, just a reinforcement of what we have been seeing over the past several months. One standout sector is data centers and power infrastructure, both magnets for capital as AI and cloud computing demand expands. The scale of projected build-out is staggering, as much as $5 trillion globally over the coming decade, according to JP Morgan, spanning project finance, structured credit, public bond issuance, a capex supercycle, according to some. Firms like Oracle, Meta, and Alphabet have all tapped corporate bond markets to fund these projects, while infrastructure funds and private lenders are layering on additional leverage. That dynamic has prompted a quiet warning from the Bank of England, which we recently flagged, and the potential systemic implications of rising exposure to highly specialized capital-intensive sectors. We're already seeing some repricing in technology-linked bonds, spreads widening modestly as risk departments begin to cap exposure. That's a healthy development. It suggests the market is still functioning as it should, pricing risk dynamically rather than chasing yield blindly. But it also implies that financing costs for the next wave of projects will be higher, potentially slowing some of that planned expansion. Recent results from Taiwan's semiconductor offer a timely signal. Global chip demand growth has begun to ease slightly, reminding investors that even transformative sectors face cyclical pauses, and while there is a race on, there is only so much capital available to fight for. It may be time to tap the equity markets. So, where does that leave us this week? The UK is finally making progress on inflation, but the price is a cooling labor market and rising joblessness. That's not the worst outcome in macro terms. Central banks wanted to see this, but politically and socially, it's a difficult trade-off. As we approach the budget, expectations are muted, but low expectations can be a powerful asset. If Rachel Reeves manages even modest fiscal clarity, a credible path for investment without spooking the gilt markets, sentiment could return surprisingly quickly. Looking ahead to 2026, at the moment, the UK stands at a bit of a crossroads. One path is continued stagnation, slow growth, cautious corporates, and a still tight policy mix. The other is a modest rebound as inflation normalizes, uncertainty premiums fade, and investment pipelines begin to reopen. For investors, that dual-track scenario means positioning matters, and contrarian optimism might pay. Across Europe, private markets are on the front foot. Credit remains well bid, balance sheets look solid, and while the AI-driven investment surge carries risks, it's also creating a once-in-a-generation financing wave, one that European lenders and credit funds seem well placed to capture. That's it for this week's edition of the Credit Compass. If you found today's discussion useful, please follow, rate, and share the show. It really helps others discover it. And if there's a topic you'd like us to explore, please drop us a line. We're always open to listener ideas. For deeper insights and data-driven analysis on macro and credit trends, please visit kbra.com/macro credit, our dedicated hub for all things macro, markets, and credit dynamics. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.